plan or post-employment plan in this particularly with regard to the scheme of defined benefit plan in the profit and loss or income statement, and also the statement of financial position. So inshallah today I will look into few more issues. The first issue which I will basically address today is issue related to remeasurement. The first type of remeasurement actually we have discussed in the previous class. So the measurement can basically arise from the measurement of defined benefit obligation, because we are comparing between what we have calculated in the books, in our books, and also the actuarial estimation. And remeasurement can also arise from the fair value estimate, okay, of the plan asset. And so I will just continue from that, okay, because there are a few other types of remeasurement which could also arises from the measurement of post-employment benefit plan. So I will start with that, okay. Then I will look into asset ceiling test, because that is also where the remeasurement can basically arise. Then I will show you a bit more of detail based on the example given in the textbook related to how present value estimation of defined benefit obligation is calculated. A bit more. We have looked into the basic principle in the calculation, but how would you really measure, okay, the present value of the defined benefit obligation? And then we will end with some issue related to curtailment and settlement. Okay, I usually will not discuss much with regards to disclosure requirement of the accounting standard, because that is something with regard to just a presentation of information in your financial statements. So that is what I basically will try to do. So inshallah today we were able to finish off the slides on employees benefit. So the remaining classes we will look more into examples. Okay, examples. For example, this coming Wednesday we will look more on additional example on post-employment benefit. The following week we will look into more examples and also a bit more of revision, particularly with regards to topic on revenue recognition and also post-employment benefits. Okay, so that is what I planned. Any question before I start my discussion today? Any questions? Anything you would like to raise before I start discussion?
No, sir.
No? Okay. Okay, so I will continue my discussion on employees benefit. Okay, let me just share you the screen. So I will start with remeasurement. Okay, I will start today's discussion on this slide. Okay, remeasurements. Okay, so if you look into these slides, okay, if you look into the slides, sorry, there are three types of remeasurement which can basically arise, okay, in terms of measurements of measurement of post-employment benefit. Okay, so the first one is actually we have discussed in our previous class. Okay, this is where the remeasurement arises from the change in the measurement of your defined benefit obligation, and also from the change in the measurement, okay, in your plan asset between your book value and also and the actuarial estimation. Okay, according to the standard, you need to use the actuarial estimation, okay, and carry the balance of your defined benefit obligation and your plan asset at the actuarial estimates. Okay, so any difference between the carrying value of your defined benefit obligation and the plan asset will be recognized either as actuarial gain or losses. For example, an increase in the value of defined benefit obligation should be recognized as actuarial losses. An increase in the value of the plan asset, that is basically actuarial gain. So let me just complete the remaining two. Okay. The second category of remeasurement is basically the difference between your estimate of expected return from your plan asset and the actual returns. Okay, actual returns. Okay, because you will first estimate based on what is your expected return. Okay, from your plan asset, but when you really get the return, okay, when you get the return at the end of the year, the actual return might not be the same as what you have calculated from your estimation. Okay, so any differences will also be recognized here. And the last one is basically effect of the asset ceiling test. Okay, so this asset ceiling test, we will have one examples illustration from the books. Inshallah, I will go through that examples. Okay, so this is the three type of remeasurement which could arise from the measurement of your post-employment benefit plan. So I think I will go into the asset ceiling task. Okay, so we have discussed about past year service cost, and I think I have basically highlighted in the previous class whenever you have past year service cost, this will be an additional expenses to the company or to the entity, and that will basically appear in your profit and loss account. Okay, so so it will be basically treated as an additional expense which the entity or the company need to incur. Okay, so now let us look into asset ceiling test. Asset ceiling test situation arise. Okay, I think we have discussed in the previous class whenever we want to present in your statement of your financial position, you have defined benefit obligation. You also have the plan asset. Okay, so in terms of the requirement of MFRS 119, the presentation of these two items must be presented on the net basis. So if your defined benefit obligation is higher than the value of your plan asset, so the net effect is you will have um, a defined benefit liability because your obligation is basically higher than the value of the plan asset. However, if your value of the plan asset is higher than the value of your defined benefit obligation, the net implication is when you present it in your statement of financial position, you will present it as a net as a net defined benefit asset because the value of your plan asset is basically higher. Okay, is basically higher than the value of your defined benefit obligation. So here, when the plan asset value is higher, I think you might have discussed either with Dr. Fatima or earlier classes, okay, about the basics accounting principles. And one of the important principles is basically conservatism principles. Okay, so when you want to recognize liability and asset, you are a bit more conservative in recognizing um, higher value of asset. So in the conservatism principle, you have a tendency to always undervalue the asset, okay, because of the conservative nature of accountant. So when the asset values here, the asset is the plan asset. So when the plan asset value is higher than the value of your defined benefit obligation, the standard have basically request the entity to do one further additional task. Okay, one further additional task in order to ensure that the higher value of the plan asset is as what you will be presenting in in your statement of financial position reflect the accurate estimation, okay, of this situation of defined benefit asset, okay, defined benefit asset. So this is what we call the asset ceiling test, okay. This is what we call asset ceiling test. So we will need to basically calculate some other additional measure, which is the present value of possible refund or reduction in future contribution into the plan asset. And you need to compare this measure against the actual difference between the value of the plan asset and defined benefit obligations. Okay. In order to illustrate this, better we refer, if I'm not mistaken, is in example 4.9 from your textbooks. Okay. Okay, 4.9 from your textbooks. Okay, so this example. Okay, this is the situation. The asset ceiling test is only required when the value of your planned asset is higher than the value of your defined benefit obligation. So let's say in 4.9 here, you have a business entity where the present value of the obligation is 34 million and the fair value of the planned asset is 39 million. So the planned asset value is higher than the value of the obligation by 5 million. So what you will present in your statement of financial position is basically a net defined benefit asset of 5 million. Okay, of 5 million. But due to conservative nature of our accounting principles, it requires further tests. Rather than just straight away present as a net defined benefit asset of 5 million, you need to do further calculation. Okay, so here is whether, because your plan asset value is basically higher, there should be a possibility that you will get back a refund from your contribution to the plan asset, or possibly you could also get, for example, in future years, you does not need to contribute as much as you have contributed in the current year, because now the value of the plan asset is basically more, is more than enough to basically settle your obligation in the future year. So possibly in future year, your contribution will be reduced. So this will be the benefit, yeah, which you would possibly be able to get because of your plan asset value is now actually higher than the value of your obligation. So if your calculation of possible future refunds or reduction in future contribution, of course, we don't do the calculation, but this is just a simple illustration. If you estimate that possible future refunds of possible future reductions in the contribution into the plan asset, here let's say your estimate is it is about 2 million. So now you need to choose the lower between the two. Okay, your actual difference is 5 million. Okay, but your estimate of the present value of available future refund and reduction in future contribution is only 2 million. So the standard take a conservative approach, take the lower and present the lower as your net defined benefit assets. So that's mean instead of presenting as 5 million, you only will show at 2 million. That's mean there is a reduction of 3 million from the original difference, which means that you need to reduce your plan asset value by 3 million. In this case is you need to reduce it by 3 million. That's mean you only show the fair value of the plan asset at 36 million. Okay? 36 million minus obligation of 34 million, then you will present a net defined benefit asset of 2 million. Okay, so that is what we mean by asset ceiling test. Okay, so this represent the conservative approach or nature of accountant. Okay, actual difference is 5 million. but your estimate of the present value, the benefit of having higher value of plan asset, you might possibly get some refund from the plan asset or reduction, okay, in the future contribution, but your estimate of that is only 2 million. So choose the 2 million. Okay. So that's mean you need to reduce the fair value of the plan asset by 3 million. So if you look into the journal entry over there, you will credit plan asset by 3 million, reduce it by 3 million. That means it's only 36 million, and you will debit OCI for such an adjustment. Okay. For such adjustment. So the effects now is you will only show, okay, in your net defined benefit asset of only 2 million. So so that is what we mean by asset ceiling test. Any question on this? Any question on this? On the asset ceiling test? Brothers, sisters, do you have any question? Or you're okay with the example?
Okay,
Okay,
sir.
sir. So far, so good.
Okay,
Okay, sir.
okay. So that, okay. So this is the last, the third types of remeasurement which you need to recognize in OCI. Okay, when you adjust the value of the plan asset. So if I just would like to sum up this, you might just ask why you need to do this adjustment when the obligation is higher than the plan asset. You don't do any adjustment. But when the plan asset value is higher than the value of the obligation, you need to do adjustment. So my explanation is this is a reflection of the conservatism principles. Okay. So a simple understanding of conservatism principles, accountant always have a tendency to always overvalue liability. But when it comes to asset, they will always have a tendency to undervalue it. Okay. So that is what we mean by conservatism principles. So that is my explanation, okay, on asset ceiling test. So now let us go back to the slide. Um, okay, so projected unit credit method. Okay, in terms of the principle, we already understand. Okay, so when we say about projected unit credit method is basically we are talking about a fair value, sorry, a present value calculation, okay, present value obligation of the present value measure of your obligations, okay, because you understand when we talk about post-employment benefit, we are talking about obligation in the future years, and that would basically involve most probably a very long period into the future years. So that's why we need to do a discounting approach. So in order to illustrate this, I think there is one example which is given in the textbooks. I think this example 4.11, if I'm not mistaken. Okay, let's look into that example. This example 4.11. Okay, we already know that the principle is present value, but if you want to know a bit more, how do you calculate that present value? This example 4.1 give you some simple illustration. Okay. Let us just read the example 4.11. Directors of an entity receive a retirement benefit. So the entity who has appointed a directors promise a post-employment benefit, and how it will be calculated? It will be calculated as a 10% of his final salary for his contractual period of 3 years. That means if I want to put the formula, how do you calculate how much the retirement benefit the director will basically get is 10%, okay, multiplied by his final salary, multiplied by the numbers of years in service. So this directors has been appointed on a 3 years basis. So that's mean the contract period is 3 years. His expected salary over 3 years is in the first year is 200,000 per annum. In the second year, increase to 250,000. In the third year, again increase to 300,000. Okay. So now how you calculate? Assume 5%, 5% interest rate. That is basically for the purpose of discounting. Okay. Calculate how much is the service cost and the pension liability for all the 3 years. Okay. Now you need to basically calculate how much would be the post-employment benefit. Okay. Okay. Post-employment benefit of the directors. Okay. Of the directors. So the formula is 10%. Okay. So take 10%. Then you multiply by the final year of the directors. Okay. Final year salary or year 3 salary. So based on the information given, you are expecting that the final year salary of the directors will be 300,000 per annum. Okay. So that's mean 10% times 300,000 is 30,000. Okay. Is 30,000. So that is the amount, and then the directors is entitled for this 30,000 for the 3 years contract period of his service. That's mean in total you need to multiply by 3 years. Okay, 3 years of service. So 30,000 multiplied by 3 years, that is equivalent to 90,000. So that is the total post-employment benefit estimation for the directors upon his retirement. 90,000. Okay, so it is 90,000. But how would the company recognize the liability? Okay, because when the directors completed his first year of service, he has already earned the first 30,000. Okay, he has earned the first 30,000. Why? Because the directors have completed the first year of service. Yes, the directors have not received yet the payment of that 30,000, but he has earned based on accrual. He has earned. Once the directors have earned that 30,000, the company need to recognize that as a liability. When the directors complete the second year of service, then the directors earn the second 30,000. So the company again now at the end of the second year need to recognize the amount earned by the directors as additional obligation or liability of the company. Then when the writers complete the third year, again now he earned the last 30,000 of that post-employment benefit, and the company need to earn, and the company need to record again an additional liability related to the post-employment benefit of the of these directors. So that is by principle how would it will be recognized. So that's why when you look into the table, so that's mean complete the first year, directors earn the first 30,000. Complete the second year of service, directors earn another 30,000. Then complete the final year, directors earn the last 30,000. Some correction, some correction. If you look into the working number 1 on page 99, in the first year, you need to calculate the present value. That means you need to use a discounting approach. So if you look into the 3 years timeline, so when the directors complete the first year of service, so of course he will only get this benefit paid at the end of the third year. So when you discount from the end of the third year to the end of the first year, because that is the point the company need to recognize the liability, that is 2 years. From the end of the third year to the end of the first year, that is a discounting for 2 years. So please correct. So when you look into the calculation, 30,000 divided by in bracket 1 plus 0.05. 0.05, that is basically interest, and you will discount it for 2 years, not 3 years. So change the 3 years to 2 years. So you will discount it by 2 years. Then when you go into the next line, okay, so when the directors completed the second year of service, now you need to discount from the end of the third year to the end of the second year. That is only 1 year, okay? That is only 1 year. So when you look into the calculation, okay, 30,000 divided by 1 plus 0.05, discounting it for 1 year, not 3 years. Huh? So the first year you discount it for 2 years. Okay, the second year you discount it for 1 year. And for the third year, there is no discounting because you're already at the end and you also earn the final 30,000. So that's mean if you want to correct it, the 3 years should be 0. Okay, so the first is 2 years, the second is 1 year, and the last one it should be 0. That's mean any figure to the power of 0 is basically 1. It's mean as if there is no discounting because you already reached the end of the third year, or the directors already at the end of the third year. So when it received that 30,000, it should also be 30,000 because there is no further discounting. Any problem with that correction? Brothers, sisters, are you okay?
Okay, sir.
Okay, sir.
Okay, okay. So, so at the end of the first year, so based on the discounted value of that 30,000, you will get 27,211. Okay. So that when you look into the final step there to complete the table, okay. So that's why at the end of the first year, you will recognize a liability of 27,211. So if you want a journal entry, it will be debit, okay? Debit employers' benefit expenses, and then credit defined benefit obligation 27211. Okay, at the end of first year, and this will be the opening value in the second year. So as we have discussed in the previous class, any opening balance of obligation, it will be subjected to interest. Okay, it will be subjected to interest. So interest now is assumed to be 5%. Okay, so for the second year, since you have an opening balance of a liability of 27211, multiply it by 5%, that is where you get 1361. Okay, so that is charged because of interest, and interest will increase the value of the obligation. At the end of the second year, you will recognize an additional liability because now the directors have earned the second 30,000. Okay, the second 30,000 he has earned. So when he has earned the second 30,000 based on your present value calculation in the above table of working number one, that is equivalent to 28,571. Okay, so opening balance of 27,211 plus interest, okay, 1361 plus the second year uh, current year service cost 28,571, you will get to 57,143 at the end of the second year, and you will bring it as an opening balance in the third year. Again, you will charge, okay, an interest because you have not paid it, so you carry that obligation, charge interest of 5%, and that is equivalent to 2857. And the last year, the third year, okay, benefit earned by the directors 30,000, it will also be 30,000 because there will be no effect of discounting because you're already at the end of the year. So that's why when you add that 30,000, it will bring you to the total liability of the company equivalent to 90,000, as what we have calculated earlier. 10% multiplied by 300,000 multiplied by 3 years, that is 90,000. So you get a perfect figures here is because there is no changes in your actuarial assumptions. Okay, if I want to give you a simple example here of no change natural assumption is interest for all the 3 years is assumed to be 5%. So no changes in interest. So that's why you can get exactly to 90,000 as if there is no actual gain or losses. Okay, So you get it perfectly to 90,000. But when there is some changes in your actuarial assumption, such as changes in interest rate or changes in your assumption about the expected salary, okay, now you assume it to be 300,000, but later maybe you revise your estimate of 300,000. So once the entity do change the assumption, or once the actuaries, okay, do change the assumption, that will probably give you a different figure, and you will need to recognize actual gain and losses. In this case, of course, we just assume nothing changes, so that's why we can show exactly you will get to the actual figure of 90,000. So this is just an illustration of how present value of the obligation can be calculated, okay, based on the estimate of the company related to the defined benefit obligations. So is that okay? Is that illustration okay? Any question you would like to ask? That is how a bit more detail how present value is calculated. Okay. Previously in the earlier example, we just based on the uh, given present value. Okay, we have not calculated it a bit more detail like this. This is just a bit more extending lah, a bit more of an extension of how you can basically derive the estimate of the present value. But your estimate might differ with the actuary's estimation. That is where actuarial gain and losses can basically arise. Okay, can basically arise. Okay. Um, any questions? Any questions again here on this projected
Sure.
unit credit method? Yep. Yeah.
The differences, how do you do the adjustment?
This is company's calculation. This is company estimate. Okay. This one is a company estimate. So when we have discussed earlier, you need to compare between the company's estimate. Here we are not illustrating the actual gain or losses. So this is the company own estimate. That's mean based on company estimate, at the end of the first year, it will be the value of the obligation will be 27211. At the end of the second year, it will be 57143. At the end of the third year is 90,000. So this is company estimation, and the company need to compare its own estimation to the actual estimates. So any difference between company own estimation, okay, and the actual estimate, that will be either be recognized as actual gain or losses. What I mean, earlier, okay, there is no changes in the assumption, so that's why you can get perfect to your initial calculation of 90,000, because that is what you expected in terms of the value of the employees benefit. Okay, 90,000, because you calculate um, from 10% multiplied by 300,000, okay, and then multiply by 3 years. But if there is any changes, even in the company's calculation, you might not be able to get perfectly to 90,000. Okay, you might not be get perfectly to 90,000. Might be a bit confusion. Actual gain or losses is basically a rise between the company's estimate and the actuary's estimate. Actuary's estimate. That is where actual gain and losses can basically arise, as what we have shown in the earlier examples. Okay. This is company own estimation, but you get a nice figure at the end because you have not changed any assumption in your own in the calculation by the company. But if the company itself change, okay, for example, its own assumption, and then it will not be, you will not be able to get exactly what you have expected at the beginning, which is 90,000. It might be something which is different. Actuarial gain or losses arise between companies' estimate and the actuaries' estimates. Is that okay, brothers? That's what we have done earlier in the previous example. Here we have not included any actual estimate. It's just company estimation on the present value of the defined benefit obligations.
Okay, sir.
It's okay? Okay. Any other questions? We are moving to the last issue. Okay, any other questions? If there is no
No, sir.
questions, okay, if there is no
No, sir.
question, I will move, okay, to the last one. Okay, to the last one. The last one is issue of curtailments. Okay, an issue related to settlement. So maybe first we want to understand what the standard mean by curtailment and what the standard mean by settlement. Okay, settlement. Okay, so curtailment means a company might stop. Okay, might stop the benefit for certain employees. Okay, so this is what we mean by curtailment. Stop the benefit to certain group of employees. Okay, so usually this will lead to what? When companies stop providing benefit to certain group of employees, of course that will affect for the entities defined benefit obligation to basically reduce. Okay, to basically reduce. So that is what is mean by curtailment. Okay, stop giving benefit to certain group due to some reason. For example, I think in the next example which I basically will provide you, this example is basically I just find it from not from the textbook, from some other, if I'm not mistaken, I take it from the illustrative example of MFRS 119 to explain about curtailment. Curtailment is basically reduction. Okay, lead toward reduction lah. Okay, lead toward reduction because you are stop. Company might stop providing the benefit to certain group of their employees. Settlement, settlement might be for certain group of employees which has been promised certain amount of post-employment benefit. Company might replace it by a full settlement. That means company might pay certain amount of money in order to settle that liabilities. That means in future years later, a company will not be required anymore to basically pay that post-employment benefit. So that is basically settlement. Okay, it's settled with a lump sum payment. However, of course, when the lump sum payment of settlement given to employees differ from your earlier calculation of the liability, again here you need to recognize the difference into your P&L. Okay, so that is basically the meaning of curtailment or settlement. So just to illustrate about curtailment, so I'm taking this from illustrative example from MFRS 119. Okay. So let's say here, why there is a curtailment? Because entity discontinue one of its businesses. So the business entity might have many type of activities or businesses. Okay, it stop one. Okay, of its businesses, and the employees of the discontinued business will earn no further benefit. So this is what we mean by curtailment. For certain group of employees, the entity have stopped providing further benefit to them. Okay. This curtailment is a result of full settlement. So company have not paid in a full settlement, but just stop. That's mean there is already some liability, but for future years there is no further benefit given to this group of employees. Okay. So let us assume okay, before this curtailment have been undertaken, okay, the net present value of the obligation is 1,000. Okay. However, because of the curtailment, the net present value of the obligation now reduced to 900. Okay, because for this group of employees, the entity have no further obligation to provide them the benefit. In terms of the plan aside, you're assuming no changes. Okay, no changes is the same. Okay, 820. So the net liability, based on this information, before curtailment, you need to recognize a net liability as of 180, the difference between obligation and the plan aside. Because of the reduction in the value of the on the present net present value of the obligation after curtailment, so the result is after curtailment, you only need to recognize a net liability of 80 because 900 minus 820 is only 80. So this is what we mean by curtailment. So you need to recognize a gain of 100 because of the reduction in the value of the net on the value of the obligation. So journal entry, from the perspective of journal entry, you will debit post-employment benefit, okay, the liability post obligation by 100 because you need to reduce it to only 900 because of the effect of curtailment. And on the credit side, you will recognize it into your P&L, okay, as again, okay, as again from curtailment. So this is what you mean by curtailment. Okay, so just a short explanation here. So whenever there is curtailment or settlement, there might be further adjustment, okay, which you need to recognize either as a gain or losses. Okay, so I will finish off my slide. Okay, so we finish projected unit credit method. Okay, and then issue of curtailment and settlement. Just some further information. Usually curtailment and settlement might have arise, might be one possible reasoning for that is because company is undergoing or going through a restructuring process, for example. So that's why you need to for example, stop providing benefit for certain group of employees, and because of that curtailment, you need to basically recognize some possible gain or losses. Most probably, it will be a gain because you stop providing future benefit. Your liability most probably basically will become lower than before. Okay. So any differences you need to basically recognize it in your P&L. This is just a different category of okay employees benefit. Okay, so the last category is termination benefit. So of course, when you terminate, okay, termination can either be from the instruction of the entity or might be from the employees themselves. So whenever there is a termination, if there is any liability need to be recognized, if there is any amount which have been promised due to termination, then of course the company need to recognize that as part of their liabilities. Okay, as part of their liabilities. So I think that is all because for disclosure, as I said, uh, please don't memorize lah. Okay, please don't memorize all this disclosure requirement. Okay, so of course company need, for example, to disclose the policy, the company policy on the employees benefit. So describe the plan. Okay, provide reconciliation between asset and liabilities in the statement of financial position, how fair value of the plan asset have basically been calculated, and so on. Okay. So this is just the requirement on information and disclosure. So that will basically end our discussion on employees benefits. So inshallah on Wednesday, I will bring in few questions, okay, for us to basically discuss, okay, few questions or few examples on some issue related to post-employment benefits. So I think that is all today. Do you have any question you would like to ask? Do you have any question? Let me just stop it first. Sorry. Where is it? Right. Okay. So any questions from brothers, sisters?
Sir, the example on curtailment, can you upload it
Uh,
later to the Google Classroom?
yeah, yeah. Okay,
Okay,
inshallah.
okay.
Okay, okay. Yes, I have not uploaded it yet. So inshallah after this, I will upload the example on curtailment. Okay, I think that is
Thank you,
Sister
sir.
Nohidayah. Okay. So any other issues? Brothers, sisters, you okay? So based on today's discussion, that is all the topic which we will basically discuss. So for the remaining few more classes, what I will do is discuss more examples and questions. Are you all okay?
Yes, sir. Okay, sir.
Okay.
Yes,
Yes,
sir.
So
sir.
okay. So if there is no further question, maybe you can review back what we have discussed. So we have few more classes. So if you have any question, you can basically raise it in our next few more classes. So I think that is all for today. Okay. So thank you very much. Thank you for your participation, for your question. Okay. So inshallah, we meet again on Wednesday. So I end today's class by Assalamualaikum warahmatullahi taala wabarakatuh.
Waalaikumsalam. Thank you.
Waalaikumsalam.